Well, welcome community members on this beautiful autumn day. Thanks for joining us again for our second weekly update. Once again, we're very lucky to have our panelists join us. And for those that haven't joined us before, I'll just run through our panelists. So it's Todd Gammel, Partner Restructuring and Risk Advisory, Peter Bembrick, our tax partner in tax consulting, Nick Noonan, Director of Henry William Lawyers, and Betty Preshaw, our Director of Debt Advisory. So, look, this is a great opportunity for you guys and ladies to throw some questions at us. Each of our panelists will give us a brief update on what's been happening since we last talked. There's always things happening. This is all about allowing you to throw some questions at us that are occupying your mind. Some of you have come to us during the week, which is great. We encourage that. As we go through this, feel free to lodge some questions on the Q&A in the Q&A box. We'll try and answer them as we go through, and then towards the end, when we get to the end of the presentation, we'll pick up on the rest. So without further ado, I'll hand over to Todd. Todd.
Afternoon all. It's a cracking day. We'll try and give you an update on some of the things that we're seeing and move into the more important things I think everybody wants to know. An update on what happened with JobKeeper's alternative testing, because that seems to be a critical issue, and also how you get the money in the interim to be able to pay JobKeeper. But there are a few other things happening as well at the same time. So what we've been doing in risk and restructuring, and there is a bit around in the media at the moment, and we've been contacted by a few media parties because everybody's now starting to move into the next phase. They're now starting to think about what their startup or restart plan looks like, and how their business is going to operate in a post social distancing or a social distancing long-term approach. So we're suggesting to parties to think about it on a reverse engineering basis, where you think about what cost it's going to cost you to set back up and how much it's going, how long that will take to get back to a sort of normal level or balanced level, and then be able to work backwards from there, what a monthly hibernation sort of value and sort of holding cost is at the moment. And that gives you an understanding about what your sort of total quantum is and how then you can go and find it, whether it be some of it from JobKeeper, some of it from this small business loan or other finance sort of structures. So that's where we're getting to. The practical issues, there's a number of things coming out around some businesses having to change for social distancing. We see it ourselves in our business, where I think it's unlikely that the government's going to let people on public transport en masse for a long time. They're going to probably encourage people to try and stay at home if you can work from home. So we don't see that our full workforce will be back in the office or working from or around the office for a while. But obviously we're learning to adapt with that now. Other places like coffee shops and whatever else will probably have to adapt into and changing their format so they can actually adhere with the requirements. That may be well part of the startup for the restaurants and hotels and clubs as that goes forward. There's also going to be costs with that. There is because everybody has been running down stock and cash and not replenishing in a lot of cases, so that will require a bit of a kickstart at the front. And payment terms, from what we're seeing, are changing because everybody is looking at how they get paid, and some people are transitioning across to cash on delivery because that's what they need to keep going, and others are winding in terms. So that will impact how people are able to fund. And then there are other opportunities where some people we're talking to are actually looking at taking some sites and being able to effectively steal them off their competitors who are in a more unstable position. And that's where some of the parties are looking for a competitive advantage out of it. There are other parties, as we said last week, who are buying up and down the supply chain to build that up, and they're using the facilities they have available to do that. So they have excess capacity in their bank facility, so they're making a real strategic play. A couple of other clients are actually looking at their business systems and doing the changeover that they've always wanted to do, but because the beast was always moving in terms of their business, it was always going to be difficult and whatever else. But in a hibernated state, it is much easier to have a transition sort of process and at least start it now so that by the 1st of July, it is fully live and you've tested it and you can roll into that. So there's all of those sort of things that are happening. And there's obviously retraining, because you're going to have WH&S issues that will arise out of this, where people are going to need to adhere with social distancing and a different approach to the way the world's going to work until we get a vaccine, and things will probably transverse back to something close to what we were pre-COVID. So one of the poll questions we have there is asking, I mean, it's probably a little bit different for accountants. For our corporates, there's a lot of people having different thoughts about it and how they're going to do it. And there is an opportunity for some people to get a competitive advantage about being able to adapt to social distancing and this impact faster than others. The other big thing that's happened this week across our industry, as everybody has seen or has a view on or commented on, is Virgin falling over. And to be honest, this has been it's been under distress for an extended period. There are reasons for the situation of where it is. It's lost money, considerable money, for the last few years. A lot of that is to do with its hedging structure, which it's materially gotten wrong, and also the way it has been able to, or the valuation of its assets. Qantas has obviously had similar issues, albeit it's bounced back stronger and faster. And the problem for Virgin was it is a volume business, and so it has been under pressure. It has a high level of debt because it's had to borrow to be able to deal with these historical issues. And then all of a sudden, the bottom of its business dropped away. In terms of if a government position could have changed it or funding it, my view is that it wouldn't have, because you needed to actually exit a few of these contracts that it has around fuel, foreign exchange, and also a lot of contracts around airports where they're just not using it now. But because of it's a volume business, it was set up to be able to maximise its value. So they were paying fixed amounts to be able to generate profits if they could put the throughput through. So it's an interesting one. It's not going to be the last thing that falls over, but it is an opportunity for a lot of the hedge funds who have a lot of money floating around. And that's some of the things we look at in the next slide. So it all goes back to that inability to service the debt and their main contracts. And they're uncompetitive long term with Qantas if they really, unless they've fixed a lot of these issues. And you can see by a lot of the parties involved, there are a lot of overseas airlines here that had been funding it and trying to assist and restructure it, but it needed a material change anyway. The VA will allow it to reset and change its business structure and look forward to probably a streamlined position. Having spoken to the government around another matter, they're not expecting a lot of people to be terminated, but they acknowledge that there will be some reduction in headcount, which is logical given that they're probably going to pull back on some of their less profitable areas and focus on the really, I think it's in the top 2 or 3 airline runs in the world, which is Sydney to Melbourne. It's profitable and there's big volume. When that comes back and how far that comes back, who knows, but that'll be one of their focuses. And there's obviously a government structure that'll be in there as well, where they waive some costs early on to try and help it get back on its feet, because that is a better option than rather than having 10,000 redundancies playing through at entitlements, which are pretty solid because they're one of the last real industries which has a very strong union presence. So that will play through. I suspect, knowing the guys from Deloitte when I worked there, that they already have a handful of people ready to go as potential buyers. They will try and keep them honest by running a very sharp process and try and get them to the best outcome. It's likely that if there is going to be an outcome, it will probably be before 30 June, I would have thought, that they'll know who it will be. There may well be negotiations after that to try and finalise it. They may even run 2 parties if they feel like it. And the reason why this is attractive to the hedge funds is they can access some cheap capital. They can buy at a deep discount, and then they can realise surplus assets, the planes, if they need to, or hold on to them. And then they can either sell or relist as well. So there's an exit plan already sort of built in for them. It's a short-term 2 or 3 year play where they can actually recover and make a 10 to 15% margin on top or potentially more, depending on how they structure it and what the cost is. That may well drive some competition, and there are obviously other parties that may be interested. So, and they would logically, that would be airlines and other transport businesses, particularly those who have some cash. At the moment, I don't think there is any airlines who have any cash, so that would have to be more government sponsored, with our friends across the ditch being the logical parties to be able to run an airline over here and be able to build from there. But yeah, I think that'll be interesting to watch over the next few weeks. It's obviously a political issue as well, with Melbourne Airport, the Queensland government and the New South Wales government going head to head to try and effectively lure Virgin to one of its sites. New South Wales trying to get it to Badgerys Creek, and Melbourne trying to get it down out to one of its sites down in Melbourne, because it is a big employer and that will make a difference. And then we have the Queenslanders, in the only way the Queenslanders are threatening to bring a large projectile to the meeting to make sure that their position is clear. And I think it's unlikely that anybody will be able to get around that, given the way that Queenslanders generally fight in that position. But it may depend on who the successful party is and the overall structure. So that's it from me. I'll let you get on to the important people who can tell you how you get cash at the moment from either the bank or the government.
Thanks, Todd.
And we'll have some questions at the end.
Okay, so thanks, Todd. So yeah, so JobKeeper, no surprise there. That's definitely what we're all looking at, and I know there's a lot of interest, obviously, in the what came out yesterday and in relation to the direct discretion. So I'll certainly get to that in a minute. So just obviously some of these slides have the basics which you've all been looking at. So this 30% for most of our clients, it's 30% turnover is what we're all looking at. 1,500 per fortnight, and there's some interesting practical questions, and just be interested in the sort of experiences people have had on the catch-up payments. Notice there was something in the Herald yesterday which about the cash flow, so that feeds very nicely into what Betty will certainly talk about in relation to the concerns about how people are going to fund this, so that people are waking up to the fact that it sounds good in theory. You keep your employees on, you pay them, you get reimbursed, but of course you get paid in arrears. So how do you fund that? How does businesses fund that? And there seem to be quite a few businesses that are going to have these catch-up payments. So there's a lot of practicality around that. And the 30%, even establishing a 30% turnover. And again, and I guess there's some questions coming through, so we'll address some. I'll just go through some of these points, and then we'll get onto some of the questions, I guess. But now we're getting in, really, the rubber's hitting the road, really. Obviously, we've got this ticking clock in terms of the 30th of April deadline to register, have identified the employees after you've determined that the business even qualifies to start with, and then getting everything in order and going forward. And someone's just made a point about single touch payroll. So yes, so there's certainly, and that's actually a good practical point. So I'll get to that question in a second. But so some of the practical aspects are that it'll be, once you register, then all the single touch payroll software have getting that built into it. So and there's a question about, well, what do you do if you're not on single touch payroll? So again, I'll get to that one. But certainly getting all the paperwork in order, getting people in there. There's a lot of work to do in the next week or so. And then if people miss out, I mean, I guess the rush is getting people into the beginning of the system. And of course, if you don't get in for April, there's still the opportunity to get in for May or June or later periods. So that'll be a bit less rushed. But if businesses see that turnover hasn't dropped off yet, but it might still drop off as the next couple of months go on. And of course, there's the question about the self-employed. So I don't know, we had a question, Rickley, you're on the line there. So you had a question about that, and I'm sure that others will have similar questions about the. As most of you would have obviously read, this concept of a business participant, having you know, the started with the sole trader being able to apply for themselves. And then as more information came out, and we might have touched on this last week when we moved on to partnerships, partnerships, trusts, companies being able to register for effectively business owners, people working in the business, getting partnership distributions, trust distributions, dividends, shareholders. Now, why they made the rule that only one could get it. So if, as I said, saying to Tony earlier, if Tony and I were in partnership together, and the fact that we have to then decide that only one of us gets to claim it, and then, as Tony said, maybe split the payment. I mean, it just, there's no real logic to that, but they're the rules. So there's got clients where we're getting family running it, so say through trusts, and some families will be on the payroll, some are not. So, you know, they're the sort of practical issues we're finding that that in terms of who's, because if you're on the payroll, it's easy, but if you're not, then you've got to so trying to see, well, who else can we bring into there to claim there as a participant. Now Rick's question was more, I think, a little bit about the practicality of claiming it. Now we've got a team of people in our office starting to look at the actual helping clients with the application process and getting the information together. So I think there have been some issues with the forms, and they're being dealt with. I mean, this is all changing on an hour-by-hour basis. So certainly, any issues with the applications will be sorted. So from what I understand from speaking to a couple of the guys, that certainly we know we can work out where people should be able to qualify, and we should be able to make those claims. There's a nomination form, as with employees. There's a form that you need to get each employee to sign. There's also a nomination form for the self-employed, you know, people. So a lot of that, the paperwork. But if I move down,
and Peter, just on
yeah,
that,
go ahead.
There was one thing we heard on Wednesday about the sole trader application. You're supposed to say I have 0 employees, but the form doesn't let you say 0.
Yeah,
You've got to put 1 in. Like, there's things like that they're teething problems.
All those things are being sorted through, and of course, sole traders could have employees. So I think.
But a lot of them are individuals, right?
Oh, they are. That's right. I think probably the reality is, as you say, Todd, that these sole traders are probably people that don't have employees. But theoretically, at least, there could be sole traders with employees. And look, say take a doctor that's a sole practitioner. You know, they'll be a sole trader. They'll have a receptionist. You know, there will be some with employees, tradies with employees. There's things like that. So there'll be different scenarios. So, but certainly there are practical issues with the forms, definitely, and they're all being worked through as best as possible. The last dot point about notices, yeah. So that's a bit about the paperwork there, which again, that's understanding what paperwork you need to collect. But I think one of the hardest points, and this is where probably some of the questions are coming in, is actually working out, well, which business do you even qualify? How do you work out if you qualify? And that's, maybe if we move to the next slide, I think that's where we get into that a little bit. Yeah, this is really the key, and this will allow me to go back onto a couple of the questions, and then there might be some more procedural questions that I can address separately as well. But the certainly again, as most of you are aware, the simple rules in here is you start with a you've got to find a decline in turnover period. So if the month of March works for people, and let's be clear, because there's been a bit of confusion about this initially, is that it doesn't actually matter. These numbers will not necessarily tie up to the BAS as you're lodging, and people can be monthly lodges for BAS and still be still choose to use a quarterly comparison period. And likewise, they could be a quarterly lodger but use monthly figures. So obviously they won't come straight off the BAS. But so there's a bit of flexibility in the basic rules around choosing a period that works for you, gives you the outcome. So to start with, you'd look at March 2020 and say, well, how does that compare to March 2019? And are we going to clearly show a decline in turnover of 30%, and hopefully not 31 or 32%, but something with a bit of margin that there's no real doubt. When you get into looking at, say, April, you can use April as well, and then you're obviously looking at there's a bit of projections involved, and then you're looking at, because it uses the concept of projected GST turnover. So if you're going to use a quarterly period, you're looking at the June quarter. So clearly that's a projection. I don't know, we've been looking in our certainly amongst our firm, we've been talking about helping clients with looking at their projections, and that's where I look at things generally from more of a tax perspective. But our business advisory guys that have been talking to clients, I'm sure a lot of you talking to your clients, the focus there is about looking at saying to clients, well, what are your projections? What do your budgets look like for revenue, and how robust are they? And having a closer look at them, and certainly don't want them to be too optimistic, because you're trying to actually show a decline in turnover. So you're looking at realistic projections for this purpose, but at the same time they've got to stack up. So and the ATO is not going to go back, and they will have a look subsequently, but they're not going to go back and say and fine tune it to the level of, you said you were on 30.5%, you're actually on 29.5, and so I think that the general idea, as far as I understand, is as long as they were reasonable estimates, you can rely on those. But if you clearly didn't take a reasonable method, projection approach, then there's the possibility of having to repay the JobKeeper payments. So you wouldn't want to be in that. You wouldn't want to put your clients in that position.
So Pete, that'd be on the basis that you need to get everybody to, even if it's just an email which says, here's my assumptions and here's how I think I qualify, that you've got that. So because in 12 months time, like we all struggle to remember what we did 12 months ago.
Yeah, absolutely. Document it. And look, I guess even it comes down to who's doing it. And we're finding a lot of the clients are doing the work themselves, and we're actually we're providing them guidance, even just getting them to bounce things off us. So in that case, it's getting, if the client's taking responsibility for it and lodging it themselves, then yes, document it, have
review,
have that. But if we're going to, one thing we've discussed is if we're going to actually lodge the forms for clients, we're suggesting that we need to have reviewed their forecasts, have some discussions around it, get a bit of comfort over them, because certainly it could definitely bounce back on us as advisors if we. So we're not going to just say okay, we'll give you. You're not going to say, well, it's one fee if we review it in detail. If it's you don't want to pay that, okay, well, we'll pay you less if we rely on your figures, because we don't feel we can disclaim ourselves that much, because if it goes wrong, it's still going to bounce back on us.
And the other thing that we've had with a couple of the corporates is that we've said to them, look, you're on the threshold. Get it, and if you think you change it, if you do better than what you think, right, and you don't want to actually apply it, get the cash, park it in an account, utilize it if you think you're justified. If not, leave it there, and you've still got the money sitting to one side. So at least you have the cash and you can deploy it quickly if you need to, if things go where you think it will. But if it's not, you've got the cash there to be able to return it, so there's no risk to you.
And I think if it's that's a good point, Todd. And I think if people have done this in good faith, and it's, again, as with everything, there's the provisions are there to catch people who are really trying to take advantage. But if things turn differently, or if you get things a bit wrong, then yes, okay, you may have to pay it back. If it's marginal, you may not even have to pay it back. But if you do, then and you've allowed for that, then that's fine, I suppose. And it's just everybody doing their best, I suppose, and just but having the paperwork, like the declarations from employees, and has been often you probably read a bit about this one in all-in rule, so that it's clear that you can't just offer it to some employees and not others. And if an employee that chooses not to participate or doesn't give the signed declaration, then you don't get it for them. But if you're seen to have not claimed it, only offered it to some and not others, then you're going to have problems. And so they're the sort of things you've just got to follow through. I'll probably just move on to the alternative methodology, that's the most common, the most recent thing that's come out, because that is and I won't go through all of the scenarios, because there's a few of them. There's, I think, 7 different scenarios in the ATO release, but it is worth if you've got one, it is worth having a closer look at, because it as was foreshadowed previously, it's things like if the entity started up business, that was an obvious one that they were going to come out with something to provide. Essentially, the method is look at if they've only just started up business, they'll look at the more recent periods instead of making you go back 12 months, but still allow them to claim it. Also, if there have been significant changes in the business, like a major acquisition or disposal, there's again methods to allow for that, so that one thing I was reading one to try and advise someone on how that might apply to their situation. Like if there's been a major acquisition, for example, then they would look at the period just after the acquisition, so that you're comparing. Again, the whole idea is to compare apples with apples here. So if before COVID-19 really hit, they established their business, an enhanced and an expanded business, then the HL will allow you to look at the situation as it was more recently than 12 months, and then compare it to how things are going forward, and do that comparison. And if there's been likewise, if there's been a disposal and everything's not it's not an appropriate comparison, then they're going to make adjustments. One variation on that, which I was just discussing with another accountant, actually, was he was saying his client, they didn't actually acquire a business as such. He said, well, they had a shop, they opened up a new shop. So we were working through together the different scenarios, and I don't really think that's covered necessarily, because it's not, they didn't buy a business, they sort of expanded their business in effect. I mean, they do allow for major changes in the circumstances, and perhaps that might, it just didn't seem to quite fit. So, and it's looking at, so that business had an expansion in the fact is that business grew in effect. So it just that it grew by way of opening up a new location. And so I do think in that case, he needs to look at the total turnover of the business. And I'm not sure that's quite covered, but so there's a few different scenarios there. Another one I was hoping for that it certainly wasn't covered is with service entities. And that's, I don't know if anyone's asked that one, but I know that I think that there's a major problem there if people have, like I've got one of our firm's largest clients that has it's a consolidated group, and it's a GST group, so there's no other tax issues, but they have a number of companies in the group that simply have employees, and it's largely for workers' comp, because there's different classifications, and so they're keeping different types of workers in different entities. Nick might even have something to say about this, but it's sort of done for a particular purpose, and it makes sense in a commercial sense. There's no other tax issues, but because of the way the rules are written to look at each entity on a standalone basis, these wage costs are charged across even without even a markup. So if you take things literally, they reckon the overall business will have declined by something in the 30% mark, something that will probably get them over the line. But if you look at the main trading entity on its own, they've got maybe a certain portion of the employees, but not all of them. So I've got the accountant there's got to give me some more, come up with some more details and see what we can do there. But potentially that client is going to miss out on claiming it for all their employees, because unless we can reduce the service fees being charged across between the group companies, and it'd be the same if it was a related service trust, say for example, that didn't have the exact ownership, but it was broadly part of the group. In fact, a lot of professional practices have service trusts, for example, and which employ their employees. So if you have that sort of scenario, there doesn't appear to be anything that really covers that. So I think that's, and the discretion, certainly the discretion from the ATO doesn't seem to cover that. So that there's going to be lots of anomalies, and that's certainly one of them. So I might just, so as to give Betty and Nick some time to talk as well, I might just try and address some of the specific questions here, and then we can always move on and maybe even come back to other questions.
So Tony, do you just want to ask the questions because so
Tony,
everybody can hear them?
They can't see them. Yeah,
Yep.
Sorry. Yep.
Okay. Look, Mark's asked a question around initially around assessing JobKeeper each month if the business is not on STP. So did you cover that, Peter?
Well, not specifically, because
not specifically.
I referred to STP, but obviously so from what I understand it, and I haven't probably looked at some of the nuts and bolts processes myself personally, but I think the reporting, there's as I mentioned, there's provision in the STP, in the software with STP functionality for these things to be reported. But otherwise, there are forms. I mean, there's forms that have to be lodged every month for with things like turnover numbers, and they're not going to, as I'm sure most people know, they're not going to retest your turnover and pull you back out of the system. Once you're in, you're in. But they will, whether it's just information gathering or what, but the ATO is going to want to gather everybody's turnover levels every month, and so that those forms will need to be lodged. You've got to certainly got to report numbers of employees. So that regular reporting to the ATO will be what will keep the JobKeeper payments flowing, in effect. So if people don't stay on the payroll, then they won't be eligible employees. So it's certainly likely that in a lot of businesses the employee numbers will fluctuate.
There's a question from Mike Trey regarding allowing extra time to the end of May to apply for the JobKeeper.
To the force, I'm not sure about that. I'm not sure about that one exactly. If there's anything we need to, obviously we can capture any of these points, and we can always come back. We can come back to people if there's anything that we haven't fully covered. But I mean, at the moment, I guess all I can say is at the moment we're working towards 30 April as a deadline, and which is a very tight, which obviously is a very tight deadline. So not so sure about that, because what we do know is that if you don't get in if you don't get in for April, you can certainly get in for subsequent months, but then of course you don't get the payments for April. So if Michael's question is they want to actually get it right back to the beginning, then I'm not aware specifically, but I will we'll see what there is on that, and we can send that out to the group if we get
take that one on notice. And Bernie Gordon had one question about lumpy businesses with trading down in 1 month, but on a quarterly basis, they might be in fact ahead. So
yeah, that's a good question, Bernie. Well, I mean, things can work in your favour. So if there are, and it's certainly changes in turnover don't have to be, there's no requirement for changes in turnover to be because of COVID-19. They could be because of any reason. So just so happen. So it may just so happen. And in fact, the client I mentioned that has the service entities is actually still a pretty profitable business, and may well be a little bit like the one that you're referring to, where they'll have a bit of a dip for particular reasons. But if you can squeeze them under just based on one period, and that's why again you've got to look at all the potential periods and pick the one that works best for you, then that will be great. You just get them in there, and once they're in, as long as there's no reason to question those calculations in the future, then whatever happens in subsequent periods doesn't matter.
Great, thanks, Pete. In the interest of time, we'll move on to Nick now. Good morning, Nick.
And so just before you do that, Tony, I think because one came up on, have you got the chat there? There was something that came up on chats as well. So Paul's actually using the chat function, I see.
Paul asked a question.
Yeah, I'll just address Paul's question very quickly. Sorry, Nick. So casuals obviously is a real problem. And so 2 casual jobs. So so I think that maybe Paul's partly answering his own question, but certainly you've got to register with one, as you say, Paul. Paul's saying, that they might have had a hairdresser, say casual jobs with different employers. Well, you've got to look at it from one employer. So the key test with casuals is, are you working for that employer for that 12-month period? Are they a long-term casual? And there are a few variations to that, but if the casual jobs are with unrelated businesses, then my understanding is that's generally a problem. And I think the other part of Paul's question is about if there's incorrect information and then the forms need to be amended. Well, I think that's a bit of a problem as well. And I know we've been asking questions to the ATO to that effect. So I'm not sure how easy it is to amend forms, but that's, again, if it's not possible at the moment, those things will probably be changing. So I think maybe just stop there and move on to Nick.
I have in some of the previous presentations dealt with in a bit of detail the present state of the legislation, the JobKeeper changes to the legislation, some of the new JobKeeper directions that can be given. I thought today instead of recanvassing a lot of that quite technical information, I might just deal with some of the issues and anecdotes and observations that have come across my desk in the last month or so, and one of which deals with casual employees and one of the problems that I see with casual employees. Firstly, just on the one in, all in, there has been a lot of confusion about that. The rules certainly don't make it clear that it's one in, all in, but the ATO did come out and clarify that that was the intention. But I still think there's a bit of a disconnect in respect of businesses in the first JobKeeper period ending in April, where they have employees that they have stood down. So take a business like a gym that's closed, that has stood down all of its staff, and can't afford to prepay, I guess, the $1,500 for everyone, but they might be able to pay some to do some work. I think there is a bit of a disconnect in the rules as to whether or not that sort of arrangement might be permissible, which would mean that your employee numbers could change in each JobKeeper fortnight. And the rules actually contemplate that your employee numbers may change on the basis that the rules allow for employees who have been made redundant since the 1st of March being re-engaged. And obviously the rules contemplate employees resigning or leaving for other reasons such as redundancy. So I still think there's a bit of a disconnect there, particularly about this first JobKeeper period, when the government has told businesses to go to your bank and get some finance to cover that period. It sounds easy, but practically very difficult, particularly if you're a business like a gym that's likely to be remaining closed for a long period of time. On casuals, I had a discussion with one of the community members yesterday about this, but it's something that I've considered to be a problem with the scheme, on the basis that a lot of the discussion pre-JobKeeper from the union movement was trying to get more casuals in. I guess the compromise that was made was there's a long-term casual concept that's been built into the JobKeeper rules, which means that under the nomination rules, employers are required to advise all employees which they consider to be eligible that they can participate. And what the rules do is they basically borrow terminology from the Fair Work Act about long-term casuals. And what that means is two things, and I think only one of them has been really focused on. The first one is a service requirement, so at least 12 months with the same employer. But the second one is I guess the more dangerous one, which requires regular and systematic employment. So I'm seeing a lot of employers simply nominating any casuals that have been with them 12 months on the basis that they want to get them into JobKeeper so that they can be subsidised for their wage. But the significance of that nomination is that you're essentially deeming those casuals to be regular and systematic. And under the Fair Work Act, that carries with it additional obligations, like giving entitlements to long-term casuals to things like parental leave, things like a right to request flexible working arrangements. And in respect of all of the award covered employees, any long-term casual has an entitlement to request their employment be transferred to permanent. It's not a guarantee, but they can certainly ask the question. So I think it's an unintended consequence, and I think a lot of employers are missing it on the basis that they simply want to get their 12-month casuals in, but not really knowing that it carries additional risk. And there's a case before the High Court at the moment, which is a long-term casual that claimed back pay for things like annual leave, basically alleging that they were a permanent employee. That's before the High Court, but that person was successful in the federal court. So I just think that is a bit of a problem. One of the other issues I'm seeing is in respect of redundancy. I think the reality is that if you are a JobKeeper eligible employer and you are participating in the scheme, any redundancy that you make of a JobKeeper eligible employee is likely to come under scrutiny, on the basis that it's a simple argument for an employee to make that the redundancy was not genuine because the alternative was available, which was simply to stand the employee down without pay and just pass on the $1,500. And I've already seen a few of those issues being played out. The other one is employers who are JobKeeper eligible, but electing not to participate in JobKeeper and making employees redundant. I've seen a few of those. And again, I think that's reasonably high risk play on the basis that an employee can make the same argument that you could have and should have participated in JobKeeper. And if that happened, I would have kept my job. The other redundancy issue that's being played out is there's a function built into the Fair Work Act which enables an employer to make an application to the Fair Work Commission if they think they cannot afford to make the redundancy payment. There's already been one COVID-19 related decision where it was fairly obvious that this employer had suffered significantly by virtue of COVID-19, but an analysis of the employer's books essentially led the Fair Work Commission to make a finding that they should not be relieved of the obligation to pay redundancy pay, given the impact that would have on the employees. And they essentially found that the employer had the money in the bank to pay the employees, and therefore they were. One of the unions in Victoria has essentially started this, dob in a dodgy employer page. The ATO also has a tip-off page, and this is intended to address employers who are essentially using JobKeeper in an unscrupulous way. And there's examples, including employers who are asking employees to pay an administration fee to participate. The other unintended consequence is because the rules allow an employer to re-engage an employee who has been made redundant, see employers that are asking or making conditional offers, like I will make you an offer of employment to come back with me if you agree to the following. And it's usually, reduced terms or less favourable terms, or even such that the employee is required to repay or share a portion of the JobKeeper payment. Just on stand down, obviously that's received a lot of coverage. One observation is interesting, which is under the Fair Work Act stand down rules. I'm involved in a matter at the moment, which is interesting. And what the Commission is saying at the moment is it doesn't look like they have jurisdiction to make back pay orders for employees who have been stood down invalidly, which essentially could make the Commission a bit of a toothless tiger in respect of employees who are using that avenue to try and get back pay if they think that they were stood down invalidly. So that's a bit of a watch this space. The other issue I'm seeing is employers who had stood down all of their staff pre-JobKeeper without pay because they took the view that there was no work for them to do. Since JobKeeper eligibility has now arisen, they're now requesting employees to come back to work. And there's been a bit of pushback I'm starting to see from employees that are raising, either safety concerns or querying whether the original stand down was valid on the basis that back, 2 weeks ago, there was no work for me to do, and now apparently there is work to do. And there's been, I guess, some mixed messages from government. I think the Prime Minister came out and said something like, yes, you can require your employees to work for the 750, but that can be tricky if, for example, you've got an employee that under their own remuneration arrangements are currently entitled to less than 750 a week, and all of a sudden they're being asked to work for the 750. It's actually a request for them to work more hours, and that's not permissible. All the new JobKeeper stand down directions enable employers to do is to request employees to work less hours. So I guess there needs to be some care if, as an organisation, you suddenly want your employees to start coming back to work. You need to at least show that the work is safe, but also probably demonstrate some changed circumstances. And I know for one of my clients in particular, they had shut down their retail stores but they've since relaxed that shutdown, which is lawful. They're entitled to do that. They're starting to see some more demand from their clients. So they're starting to open up some of their stores. So that's a valid reason for them to now ask people to come back to work, albeit on reduced hours. The last point to make is really just an observation that, and it probably hasn't occupied a lot of attention because the focus has been on JobKeeper and what it means and how do we get in. But given this situation is likely to last for 12 to 18 months, they're talking about 18 months for a vaccine. I think there will be a big spike in work health and safety and workers' compensation claims, whether that's physical claims, a lot of employees being asked to work from home that might not have an adequate workspace, as well as work health and safety claims. So that could be from the regulator. Like I know that the regulators are sort of doing site visits in the city and issuing improvement notices to businesses where they're not observing the 1.5 rule. But organisations will definitely need to start taking some proactive steps to introduce like self-assessments for work health and safety at home, looking at equipment and office setups for people at home. I think mental health will be a huge area. People that have experienced some form of anxiety, depression, mental illness as a result of, or at least alleging that's as a result of their working arrangements. So that's another watch this space, but there are proactive things that organisations can do to get ahead of that.
Thank you, Nick. Over to Betty.
Tony, thank you, Nick. Thanks, everyone. Look, today I'm going to talk about more about what the banks are actually looking for when applying for the government-backed SME funding, and also when it comes to the residential debt and freeing up some cash. I should mention that there's increased pressure from the government on the banks for faster turnaround times for these bridging type of finances, particularly when it relates to JobKeeper. So the major banks have actually now established a special hotline for businesses to actually speedy up that process so that they can make those payments in lieu of the payment received from the government. Moving on, so what banks are looking for when it comes to this unsecured debt, it's really, I'm assuming that most clients or most businesses have an established relationship with a bank, and some are even relationship managed. And in those instances, the business will obviously benefit because they've got an established track record, they've got an established history with the bank. But the banks do need quite a bit of information when it comes to business around the details of their business, including the target market, their years of industry experience, any website details, social media. And they do require traditional financials, so 2018 and 2019 financials and year-to-dates. Forecast P&Ls, obviously taking into account the COVID-19 impacts and specifically how they are impacting sales and expenses. And obviously, the business needs to be thinking about strategies around income recovery because these loans, as we said before, are 3-year loans, 6 months deferral of interest with a 2.5-year amortization to zero. So you do need to have a strategy around how your income will recover and also how you expect your business to get back to normal once COVID-19 is over. So detailed strategies around this. When it comes to the loan amount, it looks like the banks are usually using 3 to 4 months of operating expenses. So really understanding what your expenses will be over the next 3 to 4 months that's the loan amounts that the banks are actually are approving, despite them saying that it's unsecured up to 250. You really need to show that what your operating expenses will be over the next 3 to 4 months. And with that said, personal guarantees are still required as well. With the residential side of it, so we can go to the next slide. You can defer your mortgage repayments for up to 6 months on home loans and credit cards. It's actually quite a simple process. Each bank has their own online portal, and in it you just summarise in a paragraph how your particular situation has been impacted particularly when it comes to your ability to make repayments on your accounts. And in most instances, the banks will approve that and just pause repayments for 6 months. The banks are actually actively promoting people reduce their monthly repayments to, or their repayments, whether they're monthly, fortnightly, to their minimum amounts, because a lot of people actually make extra repayments. CBA have told all of their clients that they need to opt out of this. So they are reducing everybody's repayment to the minimum amount unless they opt out of it. So rather than opting in, you have to opt out of it. I question whether or not that's, anyway, I do think that's an odd strategy that you have to opt out of it. So some people that are potentially impacted when it comes to, you know, their income or cash flow, if they don't advise CBA that they don't want their monthly repayments reduced to the minimum, or whatever the repayment is, they will be reduced to the minimum. There's lots of redraw as well that applicants don't know about. So banks are actively allowing people to, or they always have, to redraw, you know, to be able to access redraw in their home loans. And of course, all the banks have introduced some really sharp fixed rate pricing. So a lot of this means that, you know, interest rates you might benefit from a reduction in an interest rate of up to about 1%, because the rates are are in the low 2s. So 1% on $1 million loan is $10,000 a year. So it's another way of encouraging applicants to save money. So yeah, so that's.
And Betty, just from my sort of feedback that I've had, there's been a few people who've sort of been applying for these loans and then not thinking about it. And as soon as they're confronted by the fact that you've got a $250,000 facility and you've got to pay eight grand back per month for 30 months, it's like, well, I can't do that. How am I supposed to do that? And that's where the banks are getting to. I think it's a little bit of it's a little bit misleading the way it's been sold as these great loans, but then you've got 30 months to pay back the 250,000. They're not like an overdraft facility, which just sort of sits there and rolls around.
That's right. And with that said, so you can only imagine a $250,000 facility would mean that you've got turnover of, you know, $1 million in that 4-month period for you to, sorry, I should take that back. 3 to 4 months of turnover needs to add to $250,000.
Yep.
So, you know, you really need to be generating quite a bit of business to be able to qualify for that $250,000 facility as well. So
do you also see that, like, so there'll be people will take that out because they can get it and they'll use it, and in 12 months' time, once things are stabilised, they'll roll that into new facilities or refinance and do all those sort of things?
Potentially, because then you are, you know, you can potentially take advantage of a 5-year term with with an annual review period, as opposed to the principal and interest to zero. Because I think, to your point, Todd, it's you know, it is 2.5 to amortize a $250,000 facility over a 2.5-year period. You've got to be, you know, your business needs to have recovered quite quickly, and you need to be generating quite a bit of income to be able to do that. So I'm sure the banks will be open to it, and it's certainly not a facility that's just approved. You know, you don't automatically just qualify for $250,000. You really need to show what your operating expenses will be for the next 3 to 4 months, and that's what your loan amount will be. So it's, but yeah, definitely to your point, the banks would absolutely be having to renegotiate after 12 months or whenever the business feels that it's a good time to have that discussion.
Yeah, because they won't feel like pushing people over in 12 months' time. Like that will not be what they want to do, and the government will obviously put pressure on at that stage as well. And if we're talking about an 18-month period, well, yeah, it's going to start to put pressure on.
That's right, and you know what? It's bad publicity. You know, if you've got a business that's been heavily impacted by COVID-19, and they've got through this 6-month period, but now they need to start amortising this debt, you know, and they can't because of, but they've got a good story to say that in the next 12 months, we're obviously going to recover, you know, these are our strategies, then the banks will be open to it. They're not just going to say, no, well, this is what we've told you, excuse me, well, you know, your repayments and you need to, the banks are absolutely, you know, open for discussion. It really does fall down to strategy and, you know, a good story to tell.
Yeah, and from talking to the guys that we're dealing with in the government, one of the other things they're looking at with those is making sure that, and the reason why the banks are doing it is because they're deeply concerned about people using it for fraudulent purposes, just taking it and then rolling it and effectively phoenixing the businesses and leaving the debt behind. So there is a lot of focus around those issues. So people are going to have to provide more information, I think they thought in the first place, and try and understand it a bit more, including personal guarantees and things like that. So
that's right.
It's different.
So with the bridging finance that they were talking about now, that the government's placing pressure on the banks around now, it's really, if you qualify for JobKeeper, if you believe you qualify for JobKeeper, then, you know, the banks will probably release that portion for you to pay your staff until you get your, you know, your JobKeeper. And I'd imagine that payment would have to go directly to the loan. It wouldn't be sitting as an overdraft for you to utilise for other purposes. It would be specifically for that JobKeeper, and that's why they're calling it bridging finance. So, excuse me, even though it's an unsecured facility, it would be specific for bridging finance and hence the hotline, but also other expenses as well that would need to, you know, you would need to detail, you know, in quite a good story, that you would need to sit down, you know, and really understand with your accountant what they would be.
Because the big implication is if you take that bridging finance and you take out a 250 facility, all of a sudden you're personally liable for 300 grand more.
Yes. Well,
and,
yeah.
Yeah, and you've got to look at that on the way out as well to be able to pay it back.
Yeah, that's right. So to have a $200,000 unsecured facility, you need to be having operating expenses need to be around $50,000. You know, your operating expenses need to be around $50,000 a year. So yeah, that's right. So I mean a month. Sorry.
Yeah.
Yeah.
All right, Betty. It sounds like you need a glass of water. Peter, there was one question that we could potentially circle around on.
But the ATO, some of the stuff on the ATO website, there's been more information loaded up all the time. So certainly there's specific mentions on if you're using STP, if you're not using STP, and it does make reference to sole traders and other businesses. So that would be my best, I guess, way to hopefully address that question. But yeah, okay. So I wasn't conscious that we didn't scroll down far enough, so we missed that. We also did miss Nancy's question. But no, okay, so, and again, Nick might even have a comment on this, but my understanding was that you, so certainly for this transitional period, 30th of April is the key date, so that typically this would be done on fortnightly, although certainly for this month, as long as you've got the applications in, subject to that other question about any extensions of backdating, but you know, if you work to 30th of April as the date to work out your eligibility, apply, get registered, get all the employees identified, that sort of thing, and request the payments, then yes, that was my understanding, is that's the date. 30th of April is the date to ensure that all employees have been paid, including top-up payments where they're earning below 1,500 a fortnight. So as long as you've sorted everything out by then you'll be fine, and then it sort of falls into more of a routine going forward. Does that make sense, Nick?
Yeah, agree. The provision for the first two JobKeeper fortnights, which is up until
Yep. And the other point on that was I noticed because there was stuff that the Herald article that was yesterday that was talking about all these cash flow concerns and the people not being able to fund the payments. One point that I thought was interesting was they made the point about all this being in arrears, which of course is a concern for a lot of people, but there seemed to be a suggestion that businesses will have to pay. You'll get the payment at the end of every month, but you'll have to pay employees every fortnight. Now, the way I understand, from what I've read, there is at least on one element of that. There's a flexibility that if the business is using other payment periods, like for example monthly pays, which I imagine is relatively common. So if there's a monthly pay run, that it's the ATO has the ability to allocate those monthly pays across the 2 fortnights, for example, so that you should still be complying if you're putting it in all in a monthly pay run. It's not like you have to then make separate payments across the months, across the fortnights. Again, would that be your understanding, Nick?
Would. Yep, agree.
Yeah. So certainly the Herald article didn't make that clear. So, but that certainly helps. But it doesn't change the fact that there's still an element of receiving the money in arrears.
A couple more questions, Peter.
Yeah.
One from David and one from
Yeah.
Nick Mistakis.
Yeah. Keep scrolling down. Yeah. Okay. So David, I know you're interested in this ATO in this. Now, this is where the builders outside just start making some noise. So apologies if people can hear the background noise. So your question, David. Yeah. So this. Now I haven't really looked at in detail about how you would actually apply these ATO concessions, but yeah, when as David indicates, David's question is for entities with substantial increase in turnover, how do you measure the 50% growth over 12 months? So the ATO guidance is suggesting that one scenario where they'll give some discretion is where there's been a substantial increase in turnover in a 12-month period. I'll just scroll down to that. So I'm not sure they're that prescriptive about how you measure it.
So Pete, that's on the basis that there's been a large growth and then the dip. So they're trying to actually give you an ability to be able to say, well, you're on the upwards trajectory. You're allowed to actually then allow the down.
Correct. Yeah. So that and probably there's the legislative the instrument, which is the rules, and then there's the explanatory statement, and usually the explanatory statement with examples is probably the one that provides the best guidance. But yeah, it's still pretty brief. So to David, there may not be a really clear answer to your question, but all I could really suggest is that you look at what the ATO has said and find any way to fit your client scenario into what they've said. And so it's going to come down to what seems reasonable. That there's been the basic principle that there's been a change in the business. So obviously this isn't just it's not just a numerical analysis based on the way the numbers have fallen. They're trying to, as Todd's indicated, they're trying to allow for where the business has changed substantially, and the idea is that it wouldn't be reasonable. I mean, this whole ruling is around the lack of an appropriate turnover test comparison. So it's not reasonable in any of these scenarios to simply compare turnover in one period with turnover in the previous 12 month, the same period 12 months earlier. It's just, so in this case, you're saying, well, the business has changed substantially, and the way they try and measure it is with a 50% growth. But how you do that, well, there's probably going to be different ways to do it. And so I think just if it seems to stack up, if the vibe seems to be there, then because that is actually commercially what's happened, then hopefully you'll be all right.
Peter, a question from Nick Mistakis.
Yep. Sorry, I'll just pull.
Sole traders not registered for GST.
Okay, not registered for GST. Well, from what I understand, Nick, if there was a concern about not having an ABN. Initially, there was a point about having an ABN prior to. Thanks, David. There was something about not having to have an ABN, having to have an ABN at 12th of March, and I understand that's been relaxed because there was of course you would have people who didn't have an ABN because they weren't registered for GST because they had no, as far as they were concerned, they had no real reason to have an ABN. So yes, I understand, Nick, that there is that has been relaxed. So essentially, the people in that scenario, I can't recall the exact mechanism, but people in that scenario who are genuinely sole traders who are looking to claim that payment for themselves should still be able to get in there.
Okay. Well, if there's no more questions, we might wrap that up, folks. Thanks so much for joining us again. We'll be back same time next week. If there's anything you need to know from us in the interim, please reach out. We're all accessible. And thank you. Keep well. And all the best with your endeavours, and we'll catch up next week, if not before. Thanks very much. Cheers.
Thanks all.